We've had a lot of conflicting news flow over the last several hours. Early this morning, very early this morning, we had President Trump saying total, complete ceasefire, Israel and Iran in 24 hours in a staged process. Then we had the Iranian Foreign Minister Arakshi coming out and saying, no, there is no agreement on any ceasefire. Yet, let's take a look at what oil is pricing right now. As you know, overnight we had oil at one stage down about 10%. It's still under pressure. Early Asia. Let's bring up the charts and give you a look where we're pricing. Front month NYMEX is at 66.22. Brent, the global benchmark, 69.26. So still under pressure. If things are going so well, why is oil continuing to sell off?
Yeah, it's very, very volatile, and it's the absence of confirmed information, it's the fog of war, right? And so I think in this sort of environment, the takeaway that I think I have is that physical assets tend to price risk a lot better than derivatives tend to do, right? So for instance, if you're owner of a super tanker, every time you take a super tanker into a hot zone, you're taking a $100 million bet at the minimum. That's the value of an asset. If you look at what's the lifetime earnings of...
Including the cargo or excluding the cargo?
Excluding the cargo. So
excluding the cargo, just the ship itself?
Yeah.
Okay, all right.
And if you think about, if I put on the ship owner's hat, the value of the ship over the lifetime is $500 million. So every transit into and out of a war zone is that large a bet, every single bet. So the response from ship owners and from the physical, any physical product market tends to price risk a lot better than a 2-lot or a 3-lot bet on Brent, or even a 10-lot bet, a lot in Brent. That's a few $100,000, right?
Yeah.
So so that's one thing to take away from. Now, in terms of the truce, it's too early to tell. Yeah, and this sort of conflicting news flow sort of backs up what we are seeing in various markets, right? As you saw, WTI and Brent so volatile. As a matter of fact, even forward-looking freight indicators. So we have something called the FFAs, which are used to price freight into the future, tanker freight into the future. Even they sold off last night. They did not sell off as much as Brent did. Yeah, again, an indication of how people who own physical assets tend to look at risk a lot differently. So,
I mean, going by futures, what you're trying to say, or what they could be pointing to, is we've seen Brent come off very, very sharply, right? Down close to 10% at one stage overnight. What futures seem to be pointing to is the potential for freight rates themselves to come down sharply as well. And what does that mean? Insurance costs too?
Yes, insurance costs did not go up quite as much. Yeah. But the fact that the forward rates are coming off means that ship owners are thinking, as traders on the oil side, that the risk is a little bit lower. But the scale of the reduction in Brent, where Brent is now pricing well below what it was the 12th of June, right? Forward freight indicators are still pricing at a premium to what rates were on the 12th of June. So, but forward freight markets closed before the truce was announced here. But we were starting to price in a lot of the softness which was coming from the oil markets into the tanker markets. After all, tankers move oil. So we are downstream of that market. Yeah.
Within the last 36, 48 hours, I think we had Brent going from north of 80 at one stage. Now let's bring up our wall. This would give us a very graphic look at just how sharp the move, the delta, the rate and pace of change has been. It was north of 80 at one stage, and then boom, overnight, we went just down. At one stage, almost down 10%. So we're at about, we went to 70, and now we're actually below that. What would you put the geopolitical risk premium on oil at? A lot of folks that we've been talking to say it's roughly about $10 a barrel, which according to this pricing means that's just evaporated. Has it?
Well, on the Brent, you would argue that, right? If you were to look at what the tanker markets are telling you, you would say there is some element of risk premium still in. Again, different players who are pricing risk differently and therefore pricing risk premiums differently. Just to give you a sense, Brent was up 10% or 15% at the peak of the conflict. tanker rates were up 3 times, right? So the tanker owners were saying it's a 1 in 3 chance that something is going to happen in the Gulf. Obviously, the very, very much heightened perception of risk relates to, as I said earlier, how big a bet you are taking. A tanker owner is taking a $500 million bet. An oil trader is probably taking a smaller bet. Every individual oil trader is taking a smaller bet, whereas every single owner who puts one ship into it is taking $500 million.
So this is a good way to think about it, right, for the layman or for the average viewer, right? 1 in 3 is not exactly a coin toss, right, but 1 in 3 is still pretty high. What are the odds now?
Again, the markets are still sort of closed. We're not into active trading yet. But if I were to look at where the forward markets are pricing for July, I think we are probably now maybe 1 in 5 to 1 in 6 sort of probability of something kinetic happening. I think the fact that we're getting conflicting views, it just says that the truce, if there is a truce, is uncertain, right? And so the calculus still has to speak to a little bit about what if something kinetic happens in the Gulf of Hormuz. Ship owners have seen, and the wider world has seen, a lot of jamming of GPS signals as ship owners transited the Hormuz. During the 1980s and even 2015, 2019, we've seen sporadic disruptions of the Hormuz, and that's created shocks and it's created spikes, some long run, some short run. So all of that history, right, remains in the background when we start to price June, July, and August freight rates.
Okay.